You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Happy Wednesday. As you are listening to this podcast, I am currently flying to Boise, Idaho. And no, it's not to buy potatoes, but rather to attend at a ConvertKit conference. It's called Craft and Commerce conference for creators, people who wants to grow their online business. I went there last year. I had a blast, so I'm going there again. But don't worry, I have some pre-recorded episodes for you for the rest of the week, so you're not going to be left alone. So on Monday and Tuesday, we were talking about the buy side. So how to buy, when to buy, how to use the Rockstar list. If you have not downloaded yet, you can get that list of stocks showing a positive dividend triangle at moosemarkets.com/rockstars. And yesterday I explained you how to use that list to pick the best dividend growth stocks. But once you've done that, once you've built your portfolio and it's down a few years, well, now it's maybe time to do some selling. And selling is hard. On the one side, you have winners that you want to let run forever because they're making money and you always think that there's more growth to come. So of course, you just want to let it ride. And on the other side, maybe you made some mistakes. I mean, it happened to me several times. It's going to happen to you several times. Even Warren Buffett makes mistakes once in a while. And then what are you going to do? Why is it so hard to sell your losers? Well, of course, because we always have the hope that the company will things turn around, that the market didn't understand what was happening, but it will eventually and get some love. And long story short, we think that if we held onto our stocks long enough, we will see those stock price fully recover and maybe even generate some profit. Unfortunately, the truth is we tend to hang on to our winners way too long and then they eventually fail. And we tend to hang on to our losers way too long and we just keep on losing money on the investment, but also on the opportunity cost, which is huge. On Monday, I told you about that, like playing safe or holding on to your losers, waiting, in other words, is a very bad idea because you are missing on amazing opportunity cost. And over a long period of time, the stock market always goes up. So if you're waiting on the sideline there or holding onto your losers, you are missing this opportunity. So today I'm giving you the ultimate tricks to sell your stocks at the right time. And what is even better, it doesn't matter if we are talking about a loser or a winner in your portfolio. Those are different situations, but you can use the same strategy. This part is actually a portion of the webinar I held last week. So if you want to see the full webinar, and we had some technical problems. So at one point, there is a kind of like a pause of like 3 minutes, whereas nothing happened. You just go fast forward and watch the rest. It's a 2-hour long webinar where like 1 hour presentation, 1 hour of Q&A. You can go on moosemarkets.com/webinar. So moosemarkets.com/webinar. If you go there, no emails required, no nothing. You just click on play and watch the webinar live. So that part was about how to sell your stocks at the right time. So as I said, winners, losers, different situation, same strategy. So the whole purpose here is to have a high level of conviction in your action. And in order to get that, well, you need simple rules. An investor once asked me, but Mike, you just explained why you sold stock ABC, but it sounds so simple. You just provided 2 simple sentences, and based on that, you're just selling. But how about a more in-depth analysis? But that was the whole point. If I have simple rules, I don't have to dig deeper for 5 hours and then eventually got confused with conflicting information and get paralyzed by analysis. My point is to cut the noise and follow simple rules. So rule number 1, and we have 3 rules, so it's super easy to use. Rule number 1, make sure that the numbers and the narrative are connected. In other words, we were talking yesterday about how to select great companies from the Rockstar list. I was telling you that you want to have a strong dividend triangle. So you want to have strong financial metrics, everything like growing sales, growing revenue, growing profits, growing margin, and growing dividends, like everything you want it to go upward, right? You want to have a growing, thriving business. But then you need to understand the business model. You need to be able to simplify it to ensure that you understand the risk and the potential of that company. And at that point, you will be able to build your investment thesis, to write it down. So to write down all the good reasons why you have this company in your portfolio or why you want to buy it, and how this business will be able to continue to show a strong dividend triangle. So whenever you have a very interesting story about a stock and very interesting metrics, then you have a winner. If at one point you'd still have a very seductive narrative like, oh, this company is like shifting this business model, they made an acquisition and now they're going to continue to grow. And then you look at the numbers and revenues are stagnating, organic growth is minimal or not even existing, earnings per share are in a downtrend. Well, guess what? The financial metrics are telling you that your narrative, your investment thesis is completely wrong. And this is when you should sell. So regardless if the company is in positive in your portfolio or whether it's in black or in red in your portfolio, if the numbers are not backed by the narrative and vice versa, well, then you have a pretty solid reason to sell. The second reason to sell is whenever there is a slowdown in the dividend growth, an absence of dividend growth, and then you'll see that usually it will come with a weaker dividend triangle. So you'll see that revenue and earnings are slowing down or declining. Then the dividend stops increasing or slows down its growth. So the company used to increase its dividend by like 5% for several years, and then it goes down to 3%. And then maybe next year it's going to go down to 2%, or they're going to take a pause of their dividend growth policy to resume it in the future. Those are huge red flags. And usually if you are quick enough, you'll be able to sell before the dividend cut and the final drop in the portfolio value. So tracking how the dividend trend basically. So as soon as you see a slowdown, go check the numbers, revise your investment thesis, and now you're building a pretty solid case to sell your stock like as quickly as possible. The last thing is for portfolio management reason. So portfolio management reason is often to protect yourself against those big time winners. It's amazing to have a winner in your portfolio that goes like 200%, 300%, 1,000% growth. That is amazing. But if that company now is 20%, 30%, 40% of your portfolio, now you're starting to grow your exposure to risk. And if at one point this company fails to deliver, and unfortunately that could happen more often than other, so you don't want to get caught up with a huge paper gain that you never cash in and eventually the stock price goes down. So what I like to do is I set a limit of exposure to one stock. I've already discussed that on this podcast. So my personal limit is 10%. The point is not the 10%. The point is the limit. So if your limit is at 13%, that's fine too. If it's at 5%, it's fine too. The point is, as soon as this limit has been reached, you just sell a few basis points. So maybe 1%, 2% of your position, just to drop it down a little bit. You cash on a profit, you reallocate that money into other sectors, you rebalance your portfolio, you protect your portfolio against yourself, against falling in love with a company. And the best part is, if that winners keeps on winning, well, it's going to grow back up to that limit once again. I've been selling shares of Apple like 3 times already now, just based on that limit. So of course, if I would have stayed the course, I would have had a better portfolio probably today in terms of returns. But my exposure to risk, my exposure to Apple, and now I would be living on the hope that Apple will come with a brand new product and generate a lot more sales, and then I would make more profit once again. Today, I can rest. I'm making a lot of money on it, but I'm also cashing a lot of profit to reallocate and buy shares of companies that seems like better opportunities moving forward. So quick wrap up. 3 reasons to sell at the right time. The first one, whenever the numbers are not backing your investment thesis anymore, an absence or slowdown of dividend growth in order to avoid a dividend cut, and for portfolio management reasons. So too much in a sector, too much in a stock, set your limits and then sell when you reach those limits. If you want to have the full explanation, please go to moosemarkets.com/webinar. I have a full webinar for you guys there, moosemarkets.com/webinar, 100% free. You just click on the video and it's going to start right away. No email required. All right, Moose, that's enough for today. Enjoy your day. And tomorrow, I'm going to talk a little bit more about my portfolio review for this Q2. So Q2 is almost done. It's going to end up at the end of June. Now it's time to look at it, see how it's going, and which kind of trade I want to do or I made, actually. All right, Moose, take good care and don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.